You ever find yourself just staring at a screen? Financial charts, news feeds flying by, maybe a really dense research report, and you just get that feeling, that sort of wave of overwhelm.
Oh, yeah, definitely. It's like this huge ocean of data washing over you.
Exactly. And you're trying to pick out just one thing, right? One actionable message from all that noise. How do you even find the signal? And more importantly, how do you get genuinely useful insights without spending, I don't know, hours digging through it all yourself?
Well, that's the challenge, isn't it? Finding the shortcut to understanding.
That's exactly what we're trying to do today on the deep dive. We're taking a shortcut, a deep dive, into a really compelling investment report. This one's focused on Expedia Group. The ticker is EXPE.
Ah, Expedia. Interesting one.
Yeah, and the source is this analyst known only as top trader JinLog. Now, this isn't strictly about whether to buy or sell EXPE stock. That's not the point.
Right. No investment advice here.
Exactly. We're using JinLog's report more like a masterclass, a kind of blueprint for how expert minds tackle complex information, how they turn that overwhelming data into something crystal clear.
It's about the process, the methodology.
Precisely. We want to unpack JinLog's unique approach, he calls it VPAR rhythm trading, and pull out those universal principles, things about analytical thinking, about market dynamics, that can really shed light on any complex situation you might face.
And what's really striking about JinLog's approach, I think, is how it weaves together these two worlds that often seem pretty separate.
Which worlds are those?
On one hand, you've got the super precise technical analysis, the chart patterns, the levels, the intricate movements, but then he combines that with this really sharp eye on the fundamentals.
The actual business health.
Exactly. The underlying company performance. And it's not just a basic mix and match. It feels like a real synthesis, This multi-layered view gives you such a robust perspective on what's driving the market.
So it's not just what the price is doing.
Right. It's about why it's doing it. And crucially, what patterns, what actionable insights emerge when you connect all those different dots. It's like seeing the whole movie unfold, not just a single frame.
Okay, so let's set the stage a bit more. The piece we're looking at is titled Expedia Group, Uptrend Resumes, $225 Target Insight, and the author is this top trader JinLog.
That top trader label definitely makes you pay attention. Just some real practical shops.
It does. And what caught my eye, even before getting into the analysis itself, is how his communication style is described. Apparently, he does these talk show style walkthroughs.
Huh. Interesting. Like making it engaging.
Yeah, almost theatrical, maybe. But then he backs it up with these full written reports. That duality seems really key, doesn't it?
It suggests accessibility and depth.
Exactly, like you get the digestible highlights, the engaging overview, but then you can immediately go deep into the weeds if you want to. It's like getting the headline news and the full investigative piece all in one.
That dual approach, the accessible talk show style and the deep written report, actually mirrors his whole analytical framework, this VPAR rhythm trading system.
Ah, okay. So the communication style reflects the method itself.
Precisely. And to really get what he's doing with EXPE, we need to unpack VPAR itself. He defines it as a system that first, and this is key, times the bigger flow.
Okay, times the bigger flow. What does that mean in practice? Not just picking individual trades.
No, not really. It's about understanding the larger currents, the big institutional money movements in the market, discerning the tide, not just focusing on every little wave. It's that foundational strategic view.
Got it. The macro picture first.
But then, and this is where VPR gets really disciplined, it reacts only to high-impact news near key supports. Points.
Only reacts, and near specific points. Okay, let's unpack that.
Yeah, because that's where the method gets its teeth. The stated purpose of VPR is, quote, chase returns while keeping risk contained.
Ah, the classic trading dilemma. High returns, low risk.
The fundamental tension, right? Everyone wants the upside. Nobody wants the big loss. So a structured system like VPAR tries to actively balance those forces. It acknowledges you can't just chase blindly. You need a framework.
A framework for when to get in, when to get out, and crucially, when to protect your capital.
Exactly. It's about being proactive with your strategy, but reactive in your execution. You wait for the market to confirm your setup at these key points.
And these MAC points you mentioned, they sound important. What makes them special? Are they just standard support resistance?
He implies they're more than that. They're critical levels, like historical battlegrounds on the chart where major decisions got made, places where demand repeatedly stepped in to stop a fall, or where supply overwhelmed buyers.
So defined by history.
Yeah, their demonstrated historical significance seems key. Points where the market clearly reacted, maybe reversed or consolidated strongly. And why are they crucial for risk management? Because they give you objective lines in the sand.
For stop losses or maybe reducing your position.
Precisely. If a MAC point breaks decisively, VPAR seems to dictate a disciplined, almost automatic response. It signals a shift in the market structure, demanding action based on the plan, not on hope or fear.
So it forces a reactive discipline rather than just predicting or guessing.
That's it. You're not trying to predict the future perfectly. You're building a robust plan to react intelligently to what the market is doing, especially around these historically proven pivotal zones.
That makes a lot of sense. It's about boundaries, about preserving capital first. And looking at the structure of JinLog's report, it's clearly not just a simple buy or sell call. It's really comprehensive.
Oh yeah, very holistic.
He goes from the big picture summary and investment opinion right into detailed chart explanations, then this rhythm analysis, the VPR core, then financial flow for fundamentals, and even community flow for sentiment. It's multidimensional.
Covering all the bases.
It reminds me of like a surgeon prepping for a really complex operation, you know? They don't just look at the main symptom.
They review everything. History, scans, blood work.
Exactly. Every component informs the whole picture, leading to a really integrated understanding and a precise plan. That seems to be the goal here.
That's a great analogy. That level of interconnected understanding.
So, okay, let's unpack this specifically for Expedia now. When JinLog takes his first look at EXPE in the summary, what's the headline? What's the main story he sees right now?
Well, he cuts right to the chase. He describes the price action really precisely. Says EXPE broke above a midterm supply zone, then retested and held, rebuilding an ascending box.
Okay, let's break that down. Supply zone, that's where sellers used to dominate, right? Like a ceiling.
Exactly. So breaking above it is bullish demand overcame that resistance. But the key part for JinLog, showing that VPR discipline, is the retested and held.
Meaning it went up, came back down to that old ceiling.
And found support there. It didn't break back below. That confirms the old resistance is now new support. A powerful validation.
And the ascending box, what does that suggest?
It implies the stock isn't just drifting aimlessly, it's consolidating higher in an upward sloping channel, basically building a new, stronger base for the next move up. It's a very constructive technical picture.
Okay, so a strong technical setup. Does he give specific price levels?
Oh yes, very specific. At the time of the report, the price was $195.06. He noted a short-term target of $200 and crucially adds it was hit today.
Ah, so immediate validation of the short-term momentum.
Exactly. Hitting those near-term targets confirms the trend's power and, frankly, the analysts read. It builds confidence. Then the bigger target, the swing or midterm one, is $225.
$225. Why is that level significant?
It represents a much more substantial continuation of this uptrend. Getting there would strongly confirm the larger bullish picture, likely solidify that optimism, maybe trigger some profit taking, but fundamentally validate the trend.
Targets are one thing, but what about getting in? Does he give entry points? That seems key to the VPAR idea.
Absolutely. He identifies best entries align with $178. And here's the VPAR difference. He says these are levels where demand has repeatedly shown up and win rate historically improves for this pattern.
Okay, so not just random support lines. These are statistically validated based on past performance.
That's the implication. These are price zones where, according to his data and pattern analysis, buyers have consistently stepped in and it led to profitable outcomes historically. You're playing the probabilities.
How does looking at historical win rates actually reduce risk, though?
Well, you're essentially placing your bets where the odds have historically been in your favor. Based on past behavior and similar setups, the market has shown a tendency to move positively from these levels. It increases your statistical edge, you see. It moves trading away from pure guesswork towards a more calculated, probability-based approach.
You know, for someone just trying to get a handle on stock trends, maybe feeling swamped by the daily noise, why is breaking it down like this into these super specific levels, targets, entries so helpful? It feels like it brings order to chaos, doesn't it?
It absolutely does.
Right.
Think about trying to navigate a new city without a map, just catching glimpses of things. Total chaos, right?
Yeah, stressful and inefficient.
Now imagine having a detailed map with points of interest, safe zones, clear destinations. That's what these levels provide. They turn what looks like random price wiggles into a structured narrative.
So you know where the important moments are likely to happen.
Precisely. You understand that $186 isn't just some number. It's a known demand zone, a high probability area where buyers might show up. It simplifies your decisions because you're not chasing every little move. You're waiting for the market to come to your predefined high probability zones.
It forces patience and discipline.
Exactly. It takes the emotion out and replaces it with reasoned action based on the map JinLog provides.
Okay, so building on those levels, let's dive into his specific investment opinion. It's not just buy or sell, is it? It seems really layered.
Definitely not. It's a nuanced strategy tailored for different time frames, short-term, swing, midterm. That adaptability really shows the depth of VPAR.
Right, because different people trade differently.
Exactly. One size doesn't fit all. So for the short-term strategy, he says, buy the dip toward $186.
Buy the dip, we hear that a lot, but the key is where?
Right. $186 isn't just any dip. It's that statistically validated demand zone. It's a calculated entry, not a blind guess. Then he adds, take partials into 200 to 105.
Take partials, meaning sell some of the position, not all of it.
Correct. It's a smart risk management move. You lock in some profit as it hits a target zone, reducing your risk on the rest of the position. You might even get your initial investment back out.
So you de-risk, but still keep some skin in the game for more upside.
Exactly. Disciplined profit taking.
Okay, what about the swing strategy? That's usually a bit longer, right? Days to weeks.
Yeah. Here he recommends to accumulate on a clean hold of $180. Accumulate means building a position gradually, maybe buying in pieces.
Not just one big buy.
Right. And the clean hold of $180 is critical. It means the price needs to decisively stay above $180, showing buyers are firmly in control there. Strong conviction.
And the target for the swing?
Still $225. Reinforces that midterm goal. But critically, the risk is defined. Risk to swing MAC point $169.
Ah, there's that MAC point again, the line in the sand.
Your stop loss or reevaluation trigger. If $169 breaks, the immediate bullish idea is likely wrong, the structure has changed, and you need to act based on your planned exit or reduce significantly. No hesitation.
Prevents that emotional deer in headlights moment.
That's the goal. Now, for the midterm strategy, this is about building a core longer-term position, aligning with that bigger flow.
Oh.
The advice is build core near $178. Build core suggests establishing that foundational chunk of your investment. Then it gets interesting. On $225 breakout plus hold, add on strength.
Add after it breaks out, not buy lower.
Exactly. This is adding to a position as it's proving itself, as it's gathering momentum. Once $225 is decisively broken and held, it signals the market has cleared a major hurdle, confirming the uptrend strength. You're participating in confirmed strength, not trying to guess the absolute bottom.
That requires a different kind of discipline.
It does. And the midterm risk management is also sophisticated. Watch mid-MAC point $154, reduce if lost, re-add on recapture.
So $154 is the longer-term danger zone. If it breaks, reduce, but then potentially get back in.
Yeah, if it breaks $154, the midterm bullish case is in serious doubt, so you reduce exposure. But if it then rallies back above $154 and holds the recapture, it suggests the breakdown might have been a fake out, a shakeout.
Clearing out weak hands, maybe.
Could be. And that recapture shows renewed strength, offering a higher conviction point to re-add to the position. It's flexible, adaptable risk management, very characteristic of VPAR.
You know, this is where it gets really interesting for me, and maybe for you listening too. Just the sheer level of detail in these strategies, mapping out entries, targets, and those specific risk points for different timescales. It's impressive. How does planning this all out beforehand help combat that emotional decision-making that trips up so many people?
Oh, it's absolutely fundamental. It's like the core benefit of a system like this. When you predefine everything, entry here, target there, stop loss exactly here, you're essentially creating your rule book before the game starts.
Taking the emotion out of the equation when things get hectic?
Exactly. Fear and greed are the enemies,
Yeah.
right? When the price is jumping around, your money's on the line, it's so easy to make impulsive mistakes. Hold losers too long, sell winners too soon. Classic behavioral traps.
We've all been there.
Right. But if you've already decided, if it hits $169, I reduce risk, then when it happens, you execute the plan. You don't debate it. If it hits $200, you take partials. No second guessing.
It turns it from gambling into a process.
A systematic, almost mechanical process. You let the market's action against your preset levels trigger your decisions, not your gut feeling or the crowd noise.
Yeah.
That's discipline. That's VPAR. And honestly, that's a powerful lesson for managing any high-stakes decision, not just trading. It turns chaos into a series of logical choices.
Okay, so we understand the strategy layers. Now let's get into the how. What's the technical analysis underpinning all these recommendations? This is where JinLog dives into the charts, the rhythms, the waves.
Right, these are the pillars supporting the whole structure. Let's start with the chart explanation. He describes the pattern as breakout, throwback, a support, hold, resume, uptrend within a rising channel.
Okay, that sounds like a classic bullish setup.
It really is. Highly recognized. Think of it like building pressure, breaking a ceiling, the breakout, then coming back to test that ceiling, which now acts as a floor, the throwback finding support. Once that floor holds, the price moves up again, often in a defined corridor, the rising channel.
Visually confirming the power shift from sellers to buyers.
Exactly. And the chart explanation reinforces those key levels we talked about. The entries, 186, 188, $178. The targets, $220, $25. They're not just numbers. They're visually marked and validated on the chart. Same for the MAC points, $169, $154, and those critical risk markers.
What about trend lines? Does he mention those?
He does. He notes the short-term line is merging, forming, but biased up. Biased up means even if it's choppy short-term, the underlying tilt is positive. And the swing midterm lines right above channel support, which confirms the longer trends are comfortably staying within that upward path, validating their strength.
Okay, so classic charting. Then there's the rhythm analysis. This sounds like the heart of VPAR.
It really is. This is where he gets into the details of trend, rhythm, and flow. Think of trend as the main direction. Rhythm as the pulse within that trend. Is it healthy, consistent, and flow as the underlying force, the capital moving in or out.
Trend, rhythm, flow. Interconnected.
Definitely interconnected, but distinct indicators, and their combination gives the VPAR signal.
So what does he see for XPE's rhythm? Short term first.
For the short term, trend, merge form rhythm, expanding hold, favors retests higher.
Okay, merge form trend suggests consolidation, building energy.
Exactly. Rising hold rhythm is steady upward pulse, and expanding hold flow means buying pressure is consistent, maybe growing. The combination, it strongly favors retests higher. High likelihood of pushing towards higher prices soon.
Makes sense. What about the swing time frame?
Here, the signals are stronger. Trend, accelerating held rhythm, rising held flow, expanding held $180 defense keeps continuity.
Accelerating held trend. That sounds powerful. Momentum is picking up.
Yes, increasing pace. Strong conviction. The rhythm and flow reinforce the sustained upward movement, solid buying. And the key takeaway here is that defending $180 is crucial to keep this accelerating swing trend going.
Got it. And the midterm rhythm.
Even more powerful, suggesting a bigger move. Trend, accelerating held rhythm, rising held flow, expanding held inventory cleared, odds of a topside test increase.
Same accelerating trend, but longer term. What's the inventory cleared part? That sounds significant.
It is significant. Inventory cleared means the selling pressure, maybe from early profit takers or people selling at break even, has been fully absorbed by buyers, like clearing out old stock. Once that overhead supply is gone,
there's less resistance holding the price back.
Exactly. It dramatically increases the odds of a topside test, meaning a challenge to previous highs, like that $225 target. The path looks clearer.
Wow. Okay, so chart, rhythm, and then he brings in Elliott wave analysis. How does that fit?
Elliott wave adds another layer, focusing on the psychological patterns of the market. The idea is prices move in predictable waves. Impulses with the trend, corrections against it, it maps the crowd cycles.
So what wave count does JinLog see for XPE?
Short term, he sees a wave 3 push in progress. Wave 3 is typically the strongest, most powerful impulse wave. And he adds a clean break over $205 argues for 3 of 3 extension.
3 of 3, like an even stronger wave within the strong wave.
Exactly. An exceptionally powerful extended move. So breaking $205 would strongly confirm this powerful momentum phase.
What about the swing wave count?
He suggests wave 4 finishing early wave 5 if higher low forms at 180, 2080 to $186. Wave 4 is the corrective pullback after wave 3. So if that correction finishes and finds support, making a higher low around $180, $186.
That signals the start of wave 5, the final push.
Likely the start of wave 5, the final impulse move in that sequence, pushing towards new highs.
And midterm Elliott wave.
Consistent again. Wave 3 advancing scenario. This points to a strong, sustained, multi-month move, and crucially, he links it back. Inventory cleared sets up a sustained move through $225.
Ah, so the cleared inventory supports the wave 3 count.
Perfectly. It removes the resistance that might otherwise hinder a powerful wave 3, suggesting a clear path through that $225 target. The theory matches the observed market condition.
Okay, so what does this all mean? We've got the chart pattern, the VPAR rhythm with its trend, rhythm, flow, and the Elliott wave count. How do these three technical layers work together? Does it just make the case stronger?
It makes the case exponentially stronger. It's all about confluence. Imagine three reliable, independent witnesses all telling the same core story from slightly different angles.
You'd believe this story much more strongly.
Exactly. When the chart shows a breakout and rising channel, and the VPA rhythm shows accelerating trend and flow with cleared inventory, and Elliott wave pinpoints a powerful wave 3, it creates this overwhelming conviction.
More than just looking at one indicator alone.
Much more. Any single indicator can give false signals. Chart patterns can fail. Rhythm could be misinterpreted. Elliott wave could be subjective. But when they all align, pointing in the same direction, that provides a really robust, internally consistent narrative.
So it's about cross-validation, building an undeniable case.
Precisely. It reduces ambiguity and gives the trader much more confidence to act on the strategy, knowing it's supported by multiple lines of reinforcing evidence.
Okay, that makes the technical side incredibly compelling. But JinLog doesn't stop there, right? He also brings in the fundamentals, the external factors. This feels like where the why behind the price action really comes in.
Absolutely critical. The financial flow section connects the technicals to the actual business reality. He flags strong Q2 results, specifically revenue and EPS beat.
Meaning they beat expectations for sales and profits?
Significantly. That signals strong execution and demand. Plus, GBV and room nights rose. Why? GBV is gross bookings value, total value booked. Room nights self-explanatory. These are core KPIs for Expedia.
So more people booking more stuff, a healthy core business.
Undeniably positive signals. But he also looks forward, highlighting raised guidance and operational efficiency. The company actually raised its full-year forecast for revenue, GBV, and margins.
Management signaling strong confidence in the future. That's huge.
It is. And he connects this to improved operating leverage via simplification, right-sizing, and GenAI deployment.
Okay, operating leverage means profits grow faster than revenue? And GenAI, how does that help?
Right, on operating leverage. And GenAI deployment is fascinating. Think automation, better personalization, improved search, optimized pricing, AI chatbots for service, all leading to potentially higher efficiency, lower costs, better conversion rates, higher margins.
And a perception of being tech forward, which investors like.
Exactly. Then finally, shareholder value. Healthy cash generation and share repurchases support per share value, making good cash and buying back stock.
Share buybacks reduce the share count, boosting EPS, right? And signals confidence.
Precisely. Shows management thinks the stock is undervalued and returns capital to shareholders. All strong fundamental underpinnings for the bullish technicals.
Okay, strong fundamentals, strong technicals. But no investment is risk-free. What potential problems or external factors does JinLog flag? This is where that balanced view comes in.
And it's crucial he includes this in the news risk event section. On the plus side, he notes a positive demand tone travel, both U.S. and international, recovered well, especially high-income bookings solid. That's the macro tailwind.
The rising tide lifting Expedia's boat.
And he mentions mix shift benefits, things like B2B and ads media contributing more, which helps margins. B2B often means more stable contracts, and ads usually have higher margins than just booking a flight.
Diversifying revenue helps stability. Smart. But what are the risks?
Clear execution risks flagged. Longer than planned tech migrations at hotels.com VRIBRBO. These big tech upgrades are notoriously tricky.
Migrating huge systems, data, things can go wrong, delays, glitches.
Exactly. They're complex, costly, and can disrupt service, impact financials, and hurt sentiment if they drag on or hit snags. A common but real risk.
Okay, internal execution risk. What else?
Competitive pressures. It's a tough market.
Yeah.
Booking Airbnb promotions may pressure take rates. Take rate is Expedia's cut of the booking value if competitors get aggressive with discounts.
Expedia might have to lower its prices or rates to compete, squeezing profits.
That's the worry. A race to the bottom on pricing hurts everyone's margins.
And finally, the big picture stuff.
The unavoidable macro headwinds. Potential 2H slowdown in the economy, impacting travel spending. FX, foreign exchange risks, like a strong dollar hurting international earnings. Rising oil prices hitting travel costs. And geopolitics conflicts, tensions creating uncertainty.
All things outside Expedia's direct control that could increase volatility.
Exactly. They can widen volatility bands, meaning bigger, more unpredictable price swings, even if the company itself is doing well.
It's genuinely impressive how he pulls all these different threads together. Q2 earnings, Gen AI, tech migrations, Booking.com's promotions, oil prices into one cohesive analysis. It really shows that holistic thinking, connecting the micro to the macro.
That's the art of synthesis, isn't it? It's not just listing facts. It's showing how the strong results, the AI efficiencies, the travel demand, those are the drivers supporting the uptrend, validating the technicals.
Building the why for the bullish case?
And conversely, integrating the risks, the tech migration, competition, macro stuff as the counterpoints, the potential roadblocks. He doesn't hide them. He acknowledges them and provides those MAC points as the planned response if they bite.
So the risks are factored into the plan via the MAC points.
Exactly. It creates a robust argument that accounts for both sides, giving a comprehensive, actionable understanding of the whole landscape. That integrated thinking is just invaluable.
And it's not just the numbers or operations. Market feeling, sentiment matters too. So he looks at community flow, what the crowd is thinking.
Yeah, post-check on psychology. For investor forums, maybe longer-term folks, he notes their focus on the valuation re-rating post-beach race.
Meaning the good results are making investors fundamentally rethink how much the company's worth, potentially justifying a higher price.
Precisely. A shift in perceived fair value. But in trader rooms, more short-term focused, he sees a split between buy 186 dips versus fade near $200, underscoring near-term chop.
Okay, so some traders want to buy pullbacks to support $186. Others want to sell rallies into resistance, $200. That sounds like disagreement.
Exactly. That conflict creates chop, sideways, volatile, indecisive price action in the short term. It tells you that while the bigger picture might be bullish, the immediate path could be messy, requiring nimble trading, different participants battling it out.
What's fascinating now is seeing how JinLog pulls all of this technicals, fundamentals, risks, sentiment into his final outlook. The grand summary.
Right. The outlook and risk summary is the synthesis. He leads with the core bullish drivers. B-trays, mixed benefits, B-to-B-aids, and efficiency gains support the uptrend. That's the foundation.
Reinforcing the why.
But then immediately the balanced perspective. Still, macro softness and migration execution keep downside tests to $180 on the table.
Acknowledging that even with positives, pullbacks to that key support level are possible due to those risks.
Exactly. It's realistic. It prepares you. And this leads right back to the core VPA principle. Manage risk around $154 Bachi MAC points.
The ultimate takeaway, even if you're bullish, risk management via those MAC points is paramount.
It's non-negotiable in his system. It loops right back to chase returns while keeping risk contained. The MAC points are the containment mechanism.
And he wraps it up with a brand notice, doesn't he? Reiterating that the report uses VPAR, combining chart rhythms with funds flow patterns to surface optimal entries. That feels like a perfect summary of his whole approach. How does that statement really capture everything we've discussed?
It truly does. Chart rhythms, that's the technicals we unpacked.
Yeah.
Patterns, waves, levels. Funds flow patterns, that's the underlying supply demand, influenced by fundamentals and sentiment, the capital movement. By blending these, VPR aims to surface optimal entries, those high probability, statistically validated zones. It perfectly encapsulates the holistic, disciplined, data-driven method.
And why is that standard disclaimer, all investment decisions are solely the investor's responsibility, so important to remember here?
Oh, it's vital. It's more than just legal cover. It's a reminder that even the best analysis, like JinLog's, is a guide, not a crystal ball. Markets change, unexpected things happen. Ultimately, it's your capital, your decision.
The analyst provides the map, but you have to drive the car.
Beautifully put. You have to interpret signals in real time, manage your own psychology, and take ownership of the outcome. It encourages critical thinking and responsibility, which is essential for anyone engaging with markets. It grounds the analysis in reality.
Wow, what an incredible deep dive. We started out wondering, how do you cut through all that noise, that complexity in financial reports and market data?
Find the signal.
Yeah. And through JinLog's EXPE analysis, we've really seen a masterclass. How he weaves together the technical precision, the charts, the waves with the fundamental health of the company, and even that awareness of sentiment and risks.
It's a shortcut to being truly well-informed.
It really is. It shows how all these different pieces fit together to build that coherent, actionable picture, that high conviction understanding.
And, this deep dive into just one stock analysis really highlights a broader truth, I think. It applies to making good decisions in any complex area, right? Business, science, whatever.
How so?
The principles JinLog uses are universal. Having a structured method to cut through the noise, the importance of detailed, multi-layered observation, And that critical skill of synthesizing diverse information into something coherent and actionable.
Building conviction through confluence, managing risk through discipline.
Exactly. That's how you move from feeling overwhelmed by information to feeling informed and ready to actually do something.
So here's a final thought for you listening. The next time you're facing a mountain of information, maybe it is markets, maybe it's new technology, maybe just a big personal project that feels daunting. How could adopting this kind of deep dive mindset change things? Looking for those underlying rhythms, identifying your own MAC points where decisions need to be made, connecting all the threads. How might that transform your ability to understand and then to act with real confidence? Something to think about.